Hello, everybody. This is Brad Lewis with Premier Marketing, and I'm joined by Jason Goodrich with EquiTrust. EquiTrust is one of Premier's longest standing annuity relationships. They've always been a valuable partner of ours and have been a great resource for us and our annuity agents over the last many years, actually. So, want to talk a little bit about the current state of the annuity space and where that's at, because there has been a lot of changes that have taken place over the last couple months, and it's pretty darn exciting, to be honest, because we've seen a big burst in annuity sales over the last few months, and it looks like it's going to continue to go that way. So with the current state of the economy, a mentor of mine once said that the best thing for annuity sales is volatility. And we've certainly had a lot of that over the last year or so, with the way the stock market's performed and the uncertainty in the economy, things of that nature. And I think it's just a great time to talk to your clients about their retirement and savings programs, what they have in place, and how annuities can be a part of that and offer a high level of safety and security to those retirement and savings accounts as well. As we've seen, the Fed has raised their rates over the last, they just had a rate announcement last week, I believe it was, and they've had some previous ones as well. So we're seeing the 10-year Treasury get to the heights that it hasn't been in years. And what that has led to with many carriers, including EquiTrust, is that we have really attractive participation rates, caps, and interest rates on the fixed accounts as well, that clients are finding very attractive. So I have to go back at least probably 14 years or so, 12, 14 years or so ago to see rates like what we have today. And the reason why I mention that is because it just makes a lot of sense to start talking to your clients about the safety of annuities and how they fit into their clients' portfolios, and allows them to get a great rate of return, or an opportunity to get a great rate of return with an index product, all at the same time of being safe and secure with their retirement savings and investments. So, Jason, I don't know if you have anything to add from your guys' perspective on the changes that you've seen over the past before you jump into your presentation, but I wanted to give you the opportunity to add to it as well if you have anything.
Yeah, thank you, Brad. Yeah, no, I would totally agree with you. It's obviously a great opportunity. Rates are, like you said, in places they haven't been in a dozen years. Just a quick example. A couple of weeks ago, I have a friend of mine who's a P&C agent, doesn't really do annuities or anything, and I was just talking to him, as a friend, and he mentioned, how many clients of his P&C clients are in his office, complaining about their 401ks and investments and things like that. And we had a discussion, and now he's selling annuities too, right? So it's just a great opportunity with the volatility, as Brad said, the dipping markets, and the incredible rates and opportunities on annuities right now. Brad mentioned it, but we're seeing I'll talk about this in a minute, but we're seeing a lot of people just using fixed rates. If you can get a 4% fixed account or something for a client, and then have the option and the flexibility to reallocate next year to an index strategy. So no, I just echo everything you said, but I think it's a tremendous opportunity. Clients are looking for solutions, and the annuities are the perfect solution, especially now.
Yep, absolutely. And we want to help. Premier wants to help. EquiTrust wants to help as well, to position you with your clients. And we're going to cover EquiTrust today. And if you guys have any questions, before I turn it over to Jason here, I want you to go ahead and fill out in the question profile on the GoToMeeting screen there. So if you have any questions, go ahead and type them in there. And at the end of the call today, we'll cover any questions that we can answer there for you as well. But leading into that, again, Jason Goodrich, he's our regional vice president with EquiTrust. He's been, probably one of the longest relationships I've had in the business, and always a great partner. So we're excited to have you on the call with us today, Jason, and hear what you have to update us with EquiTrust. Thanks for being with us. Take it away.
You bet. Thank you much, Brad. Good morning, everybody. As Brad said, my name is Jason Goodrich, and I'm a regional vice president with EquiTrust Life Insurance Company. I've been here pretty much since the beginning. I think my 18th year anniversary is coming up here in about a month. So first off, let me just thank you all for taking the time to join us today. Really do appreciate it. For the presentation today, I'm going to spend some time going over kind of our top products at a high level, but really trying to position the products and show you, how they're going to fit specific gaps for your clients. As Brad said, there's been a lot of increases lately, and EquiTrust is very competitive right now. Not only on a couple products, but we're competitive across the board. So whether you're looking for an index annuity, a MYGA type product, a SPIA, a traditional annuity, everything EquiTrust is very competitive on. And we'll cover that at a pretty high level. And I also do want to talk about premium bonuses. I think that's important right now. We're seeing kind of a resurgence in premium bonuses. A lot of that is because the rates are a lot higher, so you can get a premium bonus and high rates. And also a lot of clients are losing money, right? So the premium bonus helps to offset some of those losses. So we'll talk a little bit about that. Then I'm going to just talk a little bit about a CD and MYGA alternative to close out the presentation. It's a kind of really unique product that EquiTrust has that is a great option for a typical MYGA buyer or CD buyer. What it's going to do is it's going to give the client some more liquidity, some more flexibility, and you as the agent and advisor is going to pay you better for your work. So we'll close with that. And then as Brad said, we'll have some time to answer any questions you may have. With that, let's go ahead and get started. Okay, before I get into anything really, I do want to mention kind of a unique thing that EquiTrust is doing with almost all of our products that most carriers are not doing. And that is we are currently now, once again, allowing for inherited and stretch IRA money. Most carriers are not allowing that. We are on all of our products except for our market power bonus and our confidence income, which is our SPIA. Okay, so as you know, the rules changed a couple of years ago with inherited IRAs, but it's still definitely an advantage to a client, right? They can't stretch it over their lifetime. The beneficiary can't any longer, but they can still defer it up to 10 years, which from a tax perspective can be a big benefit to them. So we are allowing those on all but the two products you see in front of you. Just a quick recap or reminder on inherited IRAs. The advantages, obviously, to the beneficiaries to avoid the taxation immediately and allow it to continue to grow tax deferred. A lot of people don't realize this, but when you stretch an annuity or stretch an IRA, and you take distributions out of it, they come out as death claims. So they're not subject to the 10% tax if the client is under 59.5. So it's an advantage there too. And then EquiTrust is the only carrier, I believe, that allows you to add an income rider to a stretch or inherited IRA. And obviously for you as the advisor, the benefit is if you haven't already built a relationship with the beneficiary, it's a good opportunity to give them a good solution from a tax perspective that's going to help them, but also build a relationship with that client. We have two really good pieces on our website. We can also mail these or email these out to you on inherited IRAs. The one here you see is kind of just a recap of the changes to inherited and stretch IRAs that happened back in 2020. So it's a really good educational piece that goes through kind of the new rules and how they fit and talks about some terminology and things like that. So it's good for you and for your client. Then over here, we have a piece that's more of a sales piece, right? So we go through some case scenarios and things like that that you can show your client that helps show to them the value of deferring the taxes on that instead of taking the death claim money in a lump sum. So two really good pieces on our website. We can also email out to you. Okay, with that, let's get into the index annuities a little bit. One thing, if you're not familiar with EquiTrust, kind of one thing we were really built on, and kind of our thing has always been, is we try to keep things very clean, very simple, easy to understand products, but very competitive, right? So simple, competitive products with a lot of renewal rate integrity. And you can see here, there's 6 index annuities listed. There's really kind of 3 niches you will see with us. Number 1, premium bonuses. We'll talk more about this in a second, but we have 3 premium bonus products. We have a 10% bonus product. We have a 6% bonus product. We have an 8% bonus product. One thing to keep in mind with our bonuses is there is no vesting, right? The bonus is immediate. So if you put $100,000 into the market power bonus, the client immediately has a $10,000 cash bonus into that contract, right? There's no vesting schedule, so we're not going to take it back. Same thing with the 6% bonus and the 8% bonus. So that's kind of niche number one. Number two is accumulation. This is where, over the last few years, we've seen a big shift to accumulation type products. Very competitive there. We have a 10-year product, we have a 7-year product, and we have another 10-year product that has a rate buy-up option on it. We'll talk more about that in a second, but we have 3 products which are really designed for accumulation. And the third niche is really just back to one of our bonus products is return of premium. Once again, I'll talk about this in a second, but we do have a product that has a guaranteed return of premium built into it. It's going to be a great option for that client that for one reason or another can't get past the surrender charge, right? They're going to be able to get all the benefits of an index annuity, but have a built-in guarantee that they can get their money back in time. Okay, let's talk about the bonus annuities first. Before I do want to talk about, I think, kind of a misconception between bonus and non-bonus products. I do think a lot of people think that a non-bonus product will always beat a premium bonus product because their caps are so much higher, right? And in some cases they will, right? Some cases a non-bonus product is definitely the best option for a client, but there's also some cases where a premium bonus product is the best option. I want to show you kind of a couple of examples. So what I got here is I'm just looking at looking at a fixed index annuity with a 10% bonus and a 6% cap. That is our market power bonus. We'll look at another index annuity with no bonus but an 8% cap. That would be our market value index. Okay, and I'm going to take the best 10-year period of the S&P 500. What you see here is obviously the bonus product is going to start out ahead. It's going to stay ahead for a while. So it's going to be year 8 before that non-bonus product catches up to the bonus product. And that's in the best 10-year period. So if the client's going to access money anywhere in here, right, in that gap there, it makes sense for them to be in a bonus product, even in the best period ever, or excuse me, the best period in the last 20 years. Now let's look at the same thing, but let's take the worst 10-year period, right? We're doing the same thing, 10% bonus, 6% cap, no bonus, 8% cap. In this case, in the worst 10-year period, it takes 12 years for that non-bonus to catch up, right? Because you're starting out, $10,000 in the head, and the caps aren't that different, 6% to 8%. Right, so if the client's accessing money anywhere in here, which majority of the time they're going to be, it makes sense to be in a premium bonus product. For example, our market power bonus, which is our 10% bonus product, in many states, it's only a 10-year contract, right? So the bonus would have easily beat the non-bonus in that scenario. Okay, so something to think about. We're seeing a big shift back to bonus products with the rates being a lot higher. Where for the previous 2 or 3 years, it's been a lot of non-bonus products. So just to recap, when does a bonus make sense? Number one, if the client has a short time horizon before accessing the money, right? A good example of that is a wealth transfer. Our 10% bonus product gets used a lot for wealth transfer. For somebody that's not insurable or doesn't want to buy life insurance, they can use that. They can get the 10% bonus knowing they pass away, their beneficiaries guaranteed to get that. Number two would be annuitization. A lot of folks do laddering strategies and things like that where they're going to annuitize maybe after 5 years. With our products, you can annuitize after the 5th year. So if you're doing that based off the previous charts I just showed you, after 5 years, a bonus product is almost always going to beat the non-bonus product. So if you're annuitizing, then it would make sense to use a bonus product. And then I'm not going to talk a lot about income riders, but income rider, it obviously makes sense to have a premium bonus as well. Another area where I think it makes sense is if they're going to do 10% free withdrawals in the early years. I have a group that does a lot of this where they use it as a bridge to Social Security, right? So they're going to take out free withdrawals for 4 or 5 years before they start taking their Social Security. Well, because the 10% free withdrawals based on the account value, it's going to be higher on a bonus product in the earlier years than it is on a non-bonus product. Here's a big one we're seeing now, recover from an underperforming product. Right, if they're in a product that just hasn't performed or they're losing money or what have you, a bonus is a good way to make up for that. Get into a safe money product with still good growth potential above the bonus. Low index performance. It doesn't matter what your cap is if the index doesn't perform. For example, a lot of people, believe this year the index is going to be flat, year over year or by the end of the year. Well, in that case, it makes sense to use a bonus, right? Maybe the fixed rate. Get that 10% bonus if there's not going to be any gains in the market. Then low interest rates. If an interest rate environment's pretty low, I think it makes sense to use a bonus product, but I also think it makes sense now in a high interest rate. So, that kind of works both ways. Okay, let's talk briefly about the bonus products. We have our Market Power bonus. It's either a 14 or 10-year design. So it's 10 years in 17 states. It's 14 in the other ones it's approved. As I mentioned, it's a 10% premium bonus on any premium in the first year. That's an all upfront bonus. I'm going to take it back. Issues age 75, and the commission is street levels 8% in the 14-year states, and in it's 7% in the 10-year states. You can check with Brad, Premier, or me, and we can let you know which version you have in your state. Who's it appropriate for? Well, we just talked about that, right? It's an early accumulation, right? The other one, the big one we're seeing now, is means to offset a previous investment loss. Somebody's in a variable product, or they're rolling out a 401k that's lost a lot of money, or they're in the market. It's a great opportunity to make up some of those losses and get rid of the risk of being in the market. Second bonus product, Market 10 bonus. Now this one is a 10-year product. It is flexible premium, and the 6% bonus is paid on any premium in the first 5 years. Okay, so if you have premium in year 5, it's going to get a 6% bonus, and it's only going to have a 5-year surrender charge. As I mentioned, this one has the built-in return of premium rider at issue. There's no fee for that. It's just built into the contract. What that means is if they put $100,000 into this contract and 6 months from now something happens and they need to get their money back, they are guaranteed to get the full $100,000 back sent to them. This one goes up to age 80 and pays a 6% commission. So a little less commission, mainly because of the return of premium rider within it. Who's it appropriate for? Well, really those folks that are looking for peace of mind, right? People that for one reason or another just can't get past a surrender charge, or they have some concerns that they may need the money at some point down the road and just want to guarantee they can get it back. That's a typical purchaser of this product. Also, we see people that want to consolidate CDs, for example. As you know, if somebody has one CD, they probably have multiple CDs coming due at different times. Because the 6% bonus is for 5 years, it's a good way to consolidate accounts all into one contract and get a bonus on all that money. And the last one that we see a lot of is, if somebody that just wants to start an IRA. This is our product. This is our only product, and one of the only products in the industry that you can start with just $5,000 of qualified money. So they could open up an IRA and use this product, get a 6% bonus for the first 5 years and all their contributions. So we do see a lot of business coming in that area as well too. Here's the rates on the 2 bonus products I just talked about. The Market Power bonus with a 10%, Market 10 with a 6%. I'm not going to go through them all, but you can see the fixed accounts are 3% and 3.2, right? The point-to-point caps are both 6%. So you're getting those bonuses plus really strong growth potential with 6% S&P caps. On our Mark 5, you have 130% par or 140% par rate. So, really good growth potential at and above the premium bonus. And we are running a special right now on the income rider. Now, I'm not going to talk a lot about income riders today, but we are running a special till the end of this month where we've increased the roll-up on the 2 products I just talked about. So the 10%, 6% bonus. So what you can see, instead of a 6%, a 5% roll-up for any business received until the end of August, we are giving those clients a 9% roll-up for 10 years. That is an annually compounded roll-up. Okay, so really strong, and definitely puts us in the income game, if you have a client looking for an income rider. Just real quick on that too, a few of our competitive income rider features are, first off, our rider fee is based on the accumulation value, right? Not the higher income base. So, obviously that's a benefit to the client because the account value is going to be less than the income. Kind of a unique thing we do too with our income rider is we allow the spouse to continue it and then recalculate it on their life and pay it out for their life. Right? Most carriers don't do that. What most carriers do on a spousal continuation is they recalculate it, but then they only pay it out till the value's gone. We recalculate it and pay it out for life. We have a really strong doubler on it. With our chronic illness doubler, it doubles for 5 years and is guaranteed to stay doubled for 5 years, even if their account value goes to 0. right? Another unique thing we do is give them that guaranteed doubler for 5 years. And we have a ton of state approvals too on this. So we are approved on that and a lot of the hard to get states for income rider doublers. And as I mentioned, our roll-up rate is compounded. It's not simple. So it's a 9% compounded. Then lastly, I started the presentation by talking about inherited and stretch IRAs. We do allow you to add an income rider to an inherited and stretch IRA. And we will illustrate that. Okay, that's kind of the bonus products. Let's take a look at our accumulation focused products real quick. The first is our market value. This has been our top product the last 2 years. It's very simple, very easy to understand and explain. It's really just built for accumulation, right? For max accumulation. So we put kind of everything into the rates and caps. It's a 10-year design, goes up to age 80, 7% street level commission. Once again, everything's put into the caps and rates. That's a 10-year product. Now we have our Market 7, which is a 7-year product. Same deal though. Everything's kind of put into rates, but on a 7-year chassis. But it does go up to age 85, pays 5.5% commission at the younger ages, then reduces at the older ages. One unique thing about this is it does have this guaranteed accumulation value benefit. What that means is if somebody puts in $100,000 and in 7 years it hasn't grown to $107,000 because the market hasn't performed, we automatically raise that to $107,000. So basically what it works out to is a 1% simple interest guarantee per year. Because of that, it's getting used a lot as a CD alternative, right? They can move from that CD and they can have this 1% guarantee per year, but get an index annuity with a lot more options, okay? Kind of here's the rates. And I'm gonna start with the Market 7 because I just talked about that, but I mentioned it as a CD alternative. A lot of people are moving to this product and just using the fixed rate, right? You go to a 7-year product with a 1% guarantee on it basically and get a 4.15% fixed rate on it, right? Which obviously is going to beat CDs and is very competitive with MIGAs out there too. And then next year they can reallocate to all these different options, which are really strong. You know, a 7-year product with an 8% point-to-point cap, 200%, you know, par rate on our 2-year strategy, 175 on the 1-year Mark 5, so very strong. Then our market value, which I said is our #1 product, it's a 10-year product. It's very similar, you know, but actually the rates are even a little bit lower on the 10-year than the 7-year, just because of where the interest rate environment is. But once again, very, very strong rates and caps on here, 4% fixed, 8% point-to-point. And as I mentioned, even on this one, a lot of people are using the fixed rates. One thing I'll mention too, when you look at EquiTrust, we don't subsidize. So when you look at our rates and our par rates and our caps, they're all very competitive on every strategy, right? A lot of carriers might, you know, subsidize into one strategy so they have a really attractive rate on something, but then maybe their other strategies aren't quite as attractive. That's not the case with us, and I think that's very important, especially from a renewal rate perspective, right? If you're in a strategy that's not performing and at renew you want to switch it to something else, but nothing else is competitive, you know, that's a difficult conversation. With us, you can diversify between multiple strategies, you can reallocate, and you can know everything's going to be competitive because we don't subsidize. And the other thing that leads to is really strong renewal rate history at EquiTrust. We publish all of our renewal rates. So you can go to our website and you can see the initial rate and all the renewal rates on every annuity we've ever issued, going back to 2004. Okay, everything's out there. So we take a lot of pride in that. We try to give the client the same value year to year to year. So, I mean, sometimes, you know, renewal rates are not perfect, so sometimes they will come down. The thing with us is we can explain to you why they came down, right? If this 8% cap comes down to 7% and you call me and ask me why, I'll be able to talk to the actuaries and they'll give a specific reason why that came down, okay, that you can explain to your client. So I think it's really important to remember with us is, you know, we think way more long-term at EquiTrust. We're not just looking at the, you know, a great come-on rate, but we're looking at a rate and a product that's going to last the test of time. Okay, that's our accumulation products. Now I'm going to talk about our products that are also accumulation products, but have an option where you can pay a fee and get a little bit higher rate. Okay, these are the newest products we rolled out. Have been received very well, doing a good amount of business in them. The first one is the Market Max. It's just a 10-year product, 0 to 80. It's very similar to the market value product I just talked about. However, the difference is it has 4 buy-up options on it. I'll show you those in a second. And there is a fee of 1%. Right, that 1% fee is locked in, and they only pay that fee if they use these strategies, which you don't have to use. Okay, I'll show you that in a second here. Here's the current rates. What you can see is we have 3 strategies on there that are no fee. So if your client allocates to any of these, whatever money's allocated to those, there's no fee on it. Okay, it's these 4 that they would pay a fee on if they allocate to those strategies. Here's the current rates. You know, very competitive on the non-fee. You can see 7.5% cap on the no fee, 170% par. But if they're willing to pay that 1% fee on part or all of the money, they get a 12% cap, right? They get a 47% par rate. They get a 210% par rate on the Mark V. Illustrated rates, I don't like to talk about this a lot because I don't, you know, I'm not a big fan of being sold off illustrated rates, but you can see they're very high, obviously. Here's what I like to look at. These are the effective illustrated rates. So what these do is these take the fee into account. So this is kind of the annualized return the client would have got over the last 10 years on this. So you can see very high there. So on the point to point, you're about at 6% annualized return. You're over 8 on some of these. You're above 10 on that. So, you know, the effective illustrated rate, I think, is a good barometer to look at more than the illustrated rate. So that's the market max. Here's the market force, which is our other one. Same concept, 10-year product, buy-up options. The difference is this one has an 8% premium bonus up front on it. The other difference is the fee is 1.5%. So instead of a 1% fee, it has a 1.5% fee. Once again, that's locked in for the life of the contract. Same deal with this product, right? You got the same strategies. You got the no fee ones. You got the fee ones. Whoops, I got the wrong, that's the wrong slide in there. I apologize. Here we go. I'm on it. So here they are side by side, right? This is the no bonus. This is the 8% bonus. You can see the differences between them, right? 7.5 cap versus 6% cap. That's because of the 8% bonus. If you pay the fee, you're looking at 12% cap on the S&P on the max compared to 9% on the force. Okay. One thing I think it's important to look at when you look at fee products is what are you getting for your fee? Right, what bang are you getting for your buck? Well, you can see with EquiTrust, with ours, you're getting a lot. For that 1% fee, the client's getting a 12% cap instead of a 7.5. On the market force, they're getting a 9% cap instead of a 6% cap with the 8% bonus. All right, so they're getting a lot of value for that fee. The other thing is, you know, a lot of people are fee conscious and they just, you know, they like the idea, they love the idea of a 12% cap, but they don't love the idea of their account value potentially going down on a safe money vehicle like this. So here's just a quick strategy that maybe they could do for clients like that. If you were to put 20% in the fixed account at 4% and 80% in here, and it went down, the client would not lose any money, right? Because the 20% allocation at the 4% would make up for the 1% fee. So if the market went down, they'd still have their same account value. Now, if it went up, let's say 12%, they'd get 4% on 20% of the money and 12% on 80% of the money. So it's just kind of a way to hedge against the potential loss due to that 1% fee. And the other thing that comes up is, yes, a 12% cap sounds great, but how likely is that to happen? Well, actually, it's more likely than most people think. I'll show you some numbers here. Now, we're going back to 1980 here. Right, so we're looking at the issue dates all the way back to 1980. You can see over 78% of the time, the S&P 500's, has had a positive return. So almost 8 out of 10 years, it's gone up. What's interesting is when it goes up a lot, right? The S&P doesn't typically go up 4% or 5% or 6%. It typically goes up 20% or 25%, or it goes down 10% or 20%. Right, it doesn't do a lot of 4 or 5% gains, and you can see that here. The average return on the S&P 500 is just under 17%. Now, if we look at a 12% cap that we've been talking about, if you go back to 1980, just under 50% of the time, a 12% cap would have capped out. So if the client used that product, 10-year product, put it all in the 12% cap, based off historical data, 5 of those years, it's going to cap out the 12%. And 5 of it's not. 5 of it's going to be less than 12%, but it's going to be positive, and then some of it, then you have a couple of years probably in negative. So I thought that was interesting. I like to share that because I think I think people don't realize how often the S&P returns above 12%. Okay, I want to mention our MIGA real quick. I'm not going to much on this. I just want to show you the rates, and I'll point out the commission. We have a 3-year, we have a 5, 6, 8, and 10-year. We do pay 3% commission on the 5, 6, 8, and 10-year all the way to age 80. Still 2.25 from 81 to 90. Okay, so really strong commission on it. And here's our rates. We're getting a lot of business in the 5-year at the 4% rate. Right, so these are very competitive. Once again, these are locked in for that guarantee period, and then there'll be a 30-day renewal period at the end of it. Okay, the last thing I want to close with, and I'll pass off to Brad for any questions, is I'd mentioned at the beginning a pretty good MIGA alternative we have, and we're seeing a lot of business in it. And it really makes a lot of sense for clients that are typically looking for a MIGA or CD type product, and I'll show you why here. It's called a Choice 4. It's called a Choice 4 because there's these 4 different options that you can pick during application time. Now, 95% of the people probably choose this option, so I'm not going to talk about the other 3. There's an option on there called the liquidity and MVA version on the application. Now, this is a traditional fixed annuity, so it's an annual reset. The rate can change every year. However, first off, it's 6 years in length. Right? It's a 1.5% premium bonus. The base rate's 4%. Okay, so initially, they're going to get a 1.5% bonus on their premium. So if they put $100,000 in, they're going to start with $101,500, and that's going to earn 4% in that first year. Okay, there's a 1% guarantee on it, which should never come into play, hopefully, but then it does have 10% free withdrawals. Okay. So, people like this. I'll show you in a second, but people like this as a MIGA alternative because you get a similar rate, but you get a lot more liquidity. You actually may, I'll show you this too in a second, your rates actually could go up. They're not locked in at 4%, and you're getting a premium bonus. So you're getting a similar rate to a MIGA on a 6-year product with a premium bonus and 10% free withdrawals. Now, what's important about this too is renewal rates, obviously. It is a trust me product and that the rate can change from year to year. So I do want to show you some historical history on this product. It's been around since 2014, and you can see over 90% of the time it's renewed at the same as the initial rate. So that 4% rate, 90% of the time it would have renewed at 4%. Just under 8% of the time, though, it's actually increased. It's went up. Less than 2% of the time it's went down, going all the way back to 2014. So over 98% of the time, since we've been issuing these over the last 8 years, it's either stayed the same or went up. So really strong renewal rate history. And I mentioned this towards the beginning, but we publish all these rates. So you can go to our website and see any renewal rates on the Choice 4 contract. Okay, so what does it offer your client as maybe an alternative over a MIGA? First off, it's 6 years, right, with that 4% base rate, which is very competitive with MIGA products. Number 2, as we mentioned, it has a 1.5% premium bonus. Obviously, you typically don't see a premium bonus with a MIGA product. It has the free withdrawals we discussed. Instead of interest only or 5% withdrawals or something like that, it does have the 10% free withdrawals after the first year, but you can take interest withdrawals in the first year if you'd like. Renewal rate integrity, I just showed you that, but that's obviously very important with any trust me type product, whether it's an index annuity or a traditional annuity. And the term, I think this is a big one that I know a lot of people have been burned on. Typically with a MIGA, there's a 30-day window at the end of the term. And if you do not surrender during that 30-day window, it renews for another term. You don't have to worry about that with a Choice 4. At the end of the term, the surrender charge just expires. So at the end of 6 years, there's no more surrender charge on it, and there will not be another surrender charge on it, no matter what they do with it. And lastly, but not, is a strong commission. 0 to 80, it pays 5.5% street level commission on a 6-year product. And ages 81 to 85, it still pays 4.125% street level commission. Right. Once again, on a 6-year product, that's going to give the client a premium bonus and more liquidity. So I think it's a great option, as I mentioned, as a CD or MIGA alternative, and we've seen kind of a big increase in that business over the last 3 months. With that, that is all I had today. I appreciate everybody's time, but happy to pass back to Brad to see if we have any questions.
Thanks, Jason. That was really some good stuff. I hope everybody enjoyed not only learning more about the products and where EquiTrust fits, but also a few sales ideas that Jason shared too, and some niches that EquiTrust works within that makes them unique and very attractive to a lot of the producers we work with. EquiTrust has always been, like I said, one of our longest term relationships, and they're actually our largest carrier. So they get the largest share of business from our agents that we work with here at Premier. Jason mentioned one thing, and that I did want to touch on it because I hear Shad and Shay talk about it a lot, and that's the renewal rate history and the strength there. And why they've always had success with EquiTrust is because of that great renewal rate history, and you don't see that with every carrier. So if you've been around the block and you've rode a lot of different carriers, I know there's a number of them out there that don't have as good a renewal rate history as EquiTrust, and we appreciate them being such a stand-up company and keeping the promises they make to the client on the front end. I don't see any questions currently on the question list here. So if you have any questions, if you want to take a minute to chat those in real quick, we can get those answered for you. So I'll give it just a second here. I do want to mention that the annuity marketers here at Premier, we have Shad Buchanan that works here at Premier, been here about 18 years. And then Shay Treptow has been with us since 2016 or 17. And she has a ton of industry experience. So she came to us with a ton of experience. So we're happy to have both of those here to help you grow your annuity business and make sure that you have the right product mix in your bag. So when you see your clients, you can be most successful. So Jason, I don't see any questions today. So you must have done an awesome job making sure you covered everything. Appreciate everybody's time to be on the call today. Jason, thanks for being with us, man.
Yeah, thanks, Brad. I appreciate everybody's time as well.
You bet. Thanks, everyone. Have a great day. And if you need any information, please reach out to Premier. Ask for either Shad or Shay at 1-800-365-8208. Have a good one. Thank you.